Jason? As I said, for our final and best panel of the day, we have brought back, by public acclamation, John Silvia to talk about the bond market. No. Yes. And alongside and speaking first, my great and good friend, Jason Trennert, who will tell you about his own background here in Italy, but who is one of the founders of Strategas, which has in a very short period of time become one of the leading top-down analytical houses on Wall Street. Jason is the chief strategist, but they have an excellent team on economics, politics. I highly recommend that you look at their work.
That's very nice, Michael. I just, for our Italian friends here, I just wanted to say that sono cresciuto in una casa molto italo-americana. Mia madre è nata vicino a Napoli a Nola. È sempre un onore di essere qui a Milano. Mio figlio è un vero milanista con Volotelli e Enrico Cuccio, uno dei miei eroi. So è sempre un onore di essere con voi qui a Milano. And so thank you very much. Unfortunately, I can't do the entire presentation in Italian, so that probably helps you out some. And oh, there we go. This is so. I'm gonna I guess my comments today, and I'm gonna take probably what 25 minutes. Is that about right? Just because I know it's at the end of the day, probably want to keep everyone's interest level up here. But my comments are going to be a little bit different, I think, than the ones that you've heard so far. In that, you know, I think a charitable way to say it is I'm not an academic. I would say, you know, an uncharitable way to say it would be that I'm, you know, shallow. But my clients really are just focused on really what, not particularly normative judgments about what should happen, but really just more of a focus on what will happen. And of course, you know, John Kenneth Galbraith said there are two types of economists, those that don't know and those that don't know they don't know. And I'm very much in the I don't know, but I'm paid to have an opinion, and that's what I'm going to share with you today. So I think, you know, sometimes in this business, sometimes sometimes you're right for the right reasons. Sometimes you're right for the wrong reasons. You get lucky. And then sometimes you get unlucky in that you have a thesis that's correct, but it doesn't matter. And last year was one of those years for me because I was cautious on the markets last year. And I was cautious because I was worried about economic growth and I was worried about profits. And that actually turned out to be correct. There were good reasons to be cautious about both growth and profits. And S&P 500 operating earnings were only up 0.5% last year. And yet it didn't matter. Total return on the S&P 500 was 16%. And so when I got into this year, I'm saying, gee, all right, I have to perform this function for my clients. What do we do? What do we get wrong? How are we going to make things better? And part of the process was, and I'm a Republican too, so part of the process was just to learn how to stop worrying so much. And you may remember a guy by the name of Marty Zweig, who was very famous investor, made a lot of money, and he's credited with coining the phrase, "Don't fight the Fed." And I think the important thing that this slide shows you on page 8, I don't know to what extent you can see it, but is that right now you're just not fighting the Fed, you're fighting everybody. You're fighting with the exception of the ECB, which I think must change, in my own opinion. They have to expand the size of their balance sheet meaningfully. All the other central banks are going at this thing pretty aggressively. And I would also say this chart tends to show you that the Bank of Japan, while it's been doing quantitative easing for a long period of time, while the assets on their balance sheet are much higher than the other central banks as a percentage of GDP, this chart suggests that they have a lot more to do to catch up. And so it's for this reason I think that there's obviously been a lot of talk here today about an exit strategy for the Fed, an exit strategy for other central banks. I feel strongly, given my political views, that it's not a particularly, it's a suboptimal idea to have central banks print money and then have politicians spend it. Like if that worked sustainably, there'd be no need to go to work every day. Okay, so I understand very well the concept that there should be an exit strategy. But what I'm telling my clients today is that the Fed isn't even close to an exit strategy, with all due respect to the guys that really know what they're talking about. But I think, there's easing, there's tightening, there's easing, and there's where the Fed is here. It's way out here. And there's a lot of steps, as we heard today from Mr. Rosengren and Mr. Plosser. There's a lot of steps between actually aggressively easing and actually getting tight. Another reason that I think, and I'm not sure if the Fed candidly thinks about this that much, but one of the other reasons I think that the Fed will have to be very deliberate in terms of the way it exits its strategy is not only it's not only the size of the debt, but it's also the term structure of the debt that we have. And you can see here on this chart that about 50% of the outstanding debt for the U.S. matures in the next 3 years. The weighted average cost of the debt outstanding is less than 2%. And so, said another way, when you have $17 trillion in debt, you could create a big fiscal problem just on interest expense alone if you're too sudden in terms of your movements. So you have to be the Fed is always deliberate when it tightens. I think this time, given the kind of the structural problems that we have, the Fed is going to have to be even more deliberate. And so the Fed, because of policy lags, the Fed's almost always late, even when it's trying to be ahead of the curve. And this time, I think they're trying to be late. So it's a long-winded way of saying we're not making this part of the equation complicated as far as what we're telling our clients, which is, so it's kind of let the good times roll as far as risky assets and the central bank. The other, so that's one reason why we're somewhat bullish. Another reason why, that's the first reason. Another reason why we're somewhat bullish is that, and I think this is happening in the United States, I'm convinced in a way that we're creating almost a new Nifty 50. But, the original Nifty 50 was in the 70s, and those were one-decision growth stocks. And the idea is that you would pay extraordinary valuations for them because they just went up, and they were going to grow perpetually and so on. In some ways, the new Nifty 50 now is of stocks that look like bonds. It's of dividend-paying large-cap stocks. In some ways, I would argue that it's not as irrational as it might seem on the surface, because the amount, I got really intrigued by this banner headline on the part of the FT that talked about the amount of AAA-rated securities, sovereign AAA-rated securities, down 60% over the past 6 years. You lost the U.S., you lost the U.K., you lost France. And so it brings up almost domande esistenziali, existential questions about what's really a AAA-rated security. And I think that there are a number of investors in the United States that are coming to the conclusion, maybe, that Procter & Gamble, the common stock of Procter & Gamble, is closer to a AAA-rated security than French sovereign debt. It may seem crazy, but I'm convinced just by spending a lot of time talking to clients that is part of the thinking. And also, I'd say there are also kind of philosophical questions, which is to say, as a CFA, most of my clients are bottom-up analysts, right? So, and so we have to kind of break through as macro people. We have to break through that barrier. But one of the questions we get a lot is, well, what's the right multiple for the stock market if you're discounting earnings by negative real interest rates? And it's a very hard question to answer. I mean, frankly, we're kind of flying blind here. And these are this is a kind of a quick survey of PE models that I've used over time. Some of them are very simple. Others are somewhat less simple. But when I first got in the business, one of the heuristics people would use is the rule of 20, which actually empirically works pretty well over a long period of time. But it would be 20 minus the inflation rate. It was generally a pretty good idea, pretty good rule of thumb of what the PE on the market should be. Then in the 90s, people started using the Fed model. That obviously breaks down when you get to very low interest rates. And then we have econometric models at my shop. And even when I stress test those models for 4% 10-year treasury yields, the lowest number I can come up with is 18.5 times earnings for the PE. And so if you put, let's just use round numbers, let's just put $100 on S&P 500 operating earnings this year. That's not our forecast. Ours is a little bit less. It's not hard to see how the market could move up meaningfully from here. If the market believes you're going to have very, very low interest rates for an extended period of time. The last thing I would talk about, the last kind of leg of this stool of bullishness, if you will, is that I feel strongly that the great rotation that people talked about at the beginning of the year is not going to be driven by individual and retail investors. It's going to be driven by public pension funds and other fiduciaries. So at the start of the year, there was a theory that retail investors were going to sell all their bond funds and use the proceeds to buy equity funds. And while, frankly, I don't think that's the worst idea, there's very little evidence that that's happening. The flows into bond funds have continued for quite some time, and the funds that have been going into equities, money that's been going to equity funds, has come from cash. Okay, so both asset classes are actually attracting retail investments. What hasn't happened, though, is any sort of reevaluation on the part of public pension funds and endowments with regard to their liquid public equity holdings or their public equity holdings. And in my view, this is potentially a big problem. So I'll use two examples. The first one, I might offend some people here, so I apologize on both of these. They're both clients. So let's use California State Teachers Retirement System as just one example. They have an actuarial assumption of 7.5%. Okay, and last year they were up 1. And if you look at the asset allocation, it's somewhere around 25% public equities, 40 to 50% alternatives, and the remainder in cash and fixed income. And the fact of the matter is, there's just no way to get 7.5 with that type of asset allocation. It's very, very hard. Pick on another client. It's not usually a good thing to do, but these are just public, in the news ideas. Harvard. I don't know what the corpus has to throw off to. I don't know what their actual assumption is, but last year I know it's not minus 10 basis points, which is what the endowment did last year. Harvard's public equity portion of its endowment, domestic public equity portion, is 11%. Yale's is 6%, and Princeton's is 7%. So there's been a big love affair with alternative investments. The Yale model has been very, very much in vogue. And I'm convinced that, especially when it comes to private equity, my own view is that part of the attraction of these asset classes, candidly, is the opacity of the products, which is to say that after 2007, people really didn't want to have a lot of difficult conversations with clients or sponsors, right? So the interesting thing about private equity and some of these other assets is that it's kind of a take my word for it valuation. And so, and again, I'm not casting aspersions on anyone, but I think that the appeal is the idea that there's less volatility in these products than in public equities, which I think is obviously kind of prima facie absurd, because there's more risk. It's just, you just don't see it on a quarterly basis. If you look at the bottom of this page, page 14, people say, well, what would be the real, given that fear of the volatility, what would be the catalyst to get public pension funds and other fiduciaries to move into more public equities or more risky investments? And the simple answer I've come up with is just performance. It's just one of the things I've learned in 25 years, that people chase performance. No one chases performance more than consultants. And one of the ironies this year is that if you have another good year in the stock market, it's very likely that a lot of people are going to start looking at the performance and saying, well, gee, why are we paying 1 in 20 to underperform the S&P 500 by 700 basis points on both a 3-year and a 5-year basis? On a 5-year basis, right now you're still including 2008. So hedge funds and alternative investments appear very attractive. But once you drop 2008, it might become a different proposition. So again, there's very little evidence that this is happening. It's just a theory of what may happen eventually. One of the things that, and again, this is a forecast, one of the things I believe that could happen in the second half of the year in the U.S. is that you could have a big M&A boom. And the reason why I believe that is simply the cost of capital is so much lower than the return on capital right now. And also, it's been hard to generate profits organically. And it's probably very difficult at this point to generate profits through more operating leverage. So my view is when you can't generate profits through more efficiencies, the tendency is for companies to try to acquire it by buying other companies. And to me, that would be the main justification for it. And on page 20, if you want to take a look at it a little bit later, we have a list of companies that might be might be interesting targets. As far as Europe is concerned, this is again like bringing coal to Newcastle. Talking about the Fed and talking about Europe with this crowd. But I'll just give you my opinion, and I think it's shared by a lot of people here. It's just that, in my view, if the euro wants to stay together, it either has to get in order to stay together, it's got to get fiscally closer. There's two choices. You either get fiscally closer together or monetarily further apart. And I got a kick out of this article from Der Spiegel last year, but they listed their most dangerous politicians for the euro. This is seems very German. Right? They have this list of the most dangerous. And the thing I find interesting about it, what I found interesting about it, is that aside from Silvio Berlusconi, the Cavaliere, who likes to hang out with young people, the other people on this list are all young. They're youngsters. They're between 38 and 50. And so the broader point I'm trying to make is that I think the further you get away from the utopian view of why the euro should exist, the more time that goes by from World War II, from the idea of a land war, all of those sorts of things, the less interesting the concept of the euro becomes for the younger generations. That's my own opinion. I know it's from an elite perspective, the elites are all in when it comes to saving the euro. But in my view, the greater threat for the sustainability of the euro is going to be at the ballot box eventually. But there's that. I will say from a practitioner point of view, one of the things I'm really debating now, we're debating a lot internally, is whether we should go overweight financials. The financials have moved a lot off a very low base. Right now we're market weight the sector, but we're trying to figure out, like everyone else, when the velocity of money is going to pick up. Because if the velocity of money, all of this has happened, the Fed's dumped all this money out of helicopters, but it's really gone directly into bank vaults. I mean, the velocity of money has continued to go down. And we can debate how effective it is and all the rest of it, but it's taken a lot to get okay results. My view is that one of the reasons why I'm tempted to go long financials more now is that I'm of the view that we could be very close to a real pickup in the velocity of money. Because I think that financial repression, or the idea that you're going to pay negative real interest rates for a long time, not only does it force investors to take more risk, eventually, in my view, it's going to force banks to take more risk. And it's going to force them to take more risk in very traditional ways, which is to actually make loans. This is not an exhaustive survey of the loan process, but you can see here auto loans are up quite a bit already. C&I loans are up. Mortgage lending is bottoming. And one of the things I'm going to be watching very closely is home equity lines of credit, because home equity lines of credit in the United States tend to be very highly correlated with capital formation. Small business capital formation oftentimes is driven by equity in the home. And so if you can get that to turn around, you could really have something. Explosive might not be the right word, but you could have something that could be very serious. And in some ways, it could get into the you ain't seen nothing yet in terms of financial assets and stocks. Only a couple more things I'm going to show you here. Really, two more slides. So I mentioned before kind of the three reasons why I'm somewhat bullish, right? So one of them is just central bank liquidity. The second is supply-demand. The third is the underweighting of public pension funds and fiduciaries to equities. Most people, I would say, when I talk to our institutional clients, believe really that it's very Fed dependent. The stock market has really been driven by central bank liquidity. In just the last couple of weeks, and I would say this has a tinge of being perhaps a rationalization rather than a real reason, but there have been two things that have come up that are different that people are talking about. The first is that the fiscal situation in the United States, while not good in any sort of normative sense, 5% of GDP this year, is better, is meaningfully better than it's been. And people, I think, for the first time are starting to realize that that's taking place. The second thing that I think is important, and in kind of the patois of the day, a game changer, is that it looks like the President Obama, is warming up to the idea of natural gas, or is starting to include natural gas as part of his all-of-the-above strategy. And in our view, what's that? Yeah. I mean, so that's a big deal, because if you go back to the prior, one of the prior slides here, U.S. economy is still 71% of the economy is still consumer spending. And government spending, I would argue, it's going to be hard to grow C and G in this equation much from here, in my view. And I and X are going to be a much more important part of the equation for the U.S. if it wants to grow at the same rate that it has in the past. And energy is in my view, is a very convenient and also very politically popular among a majority of the population in the United States, a politically popular path. So regardless of whether you think it's a good idea or not, I think it's in the process of happening and is a real potential plus for growth. The last thing I'll show you, two last things, which has to do with dividend yields and this kind of idea of the new Nifty 50. My own view is that Apple's decision to issue corporate debt last year to increase its dividend is potentially a big uno spartiacque. It's a watershed event for the financial markets, because you're broadening out the potential sectors that can provide yield. Right, so you had a situation where a lot of investors were focusing on healthcare and consumer staples to find yield, and now all of a sudden you have a sector that is very cash rich, that is using, and I wouldn't argue that it's financial engineering, but is finding a way to provide what everyone is hungry for, which is yield. And so in my view, it's a very important, I would almost add that to the other two reasons that I mentioned before, the fiscal situation and energy as part of the change that you're seeing on Wall Street. Lastly, on page 40, I'll show you here, just to kind of speak to the idea that there is a change in terms of the way people are thinking about stocks. After U.S. debt was downgraded in August 2011, we actually counted 55 companies that had credit default swap spreads lower than that of Uncle Sam. There are 55 companies that had lower CDS than the U.S. government. Right now, there's about 22 But in the U.S., there's 140 companies that have lower credit default swap spreads than French sovereign debt. Okay? So again, we may not think that's, I mean, we could debate whether that's a good thing or a bad thing or it's crazy, and but I think part of the thinking goes is that Walt Disney doesn't have nuclear weapons, but it has money, so that, and that's a plus. So I think that's kind of where people are, and I don't see a lot that's going to change it in the short term. I think I'm right on the screws here on 30 minutes. Let me stop here. Thank you.
Quite a bit in terms of content. I would go through and just try to emphasize, what's the framework that we might use to characterize the U.S. economy, and how we deal with clients and customers, and how we advise them going forward. And we always start out with these 5 basics. I think it's a good framework. Oftentimes I do see a lot of economics presentations where the numbers are all over the place. You get 40 different slides, and there's really no coherency in the presentation. And I always like to follow this sort of framework to force me to deal with these 5 fundamentals, and use some of the graphs and illustration of what we talk about. That's the overall sense of what I'm looking at. Sustained below trend economic growth in the United States. Our guess is that potential GDP, trend GDP, is about 2 3/4 in the United States. If you were to test for mean reversion on the GDP since 1982, that's the number you get. Seems like a reasonable number. So for us, it's still slightly below trend. We're still cautious on certain consumer segments. We'll talk about that. Housing is improving, multifamily especially. This morning, multifamily was very disappointing. That multifamily number actually fell this morning when it was reported. State and local government still restructuring. I thought you saw some graphs earlier today. A lot of restructuring having to go on at the state and local level. And then employment, yes, I believe there's a lot of structural problems with the employment situation, and we'll go on with that as well. So here's GDP. To me, looking forward, giving advice to somebody over the next 3 to 5 years, ex a recession, it's 2.25% GDP, maybe a little bit higher over time. But basically, I think that's what we get. We are working through our financial problems in the United States, and I would expect that over a 3 to 5 year horizon, we would get back to at least 2 3/4% GDP growth. But I don't have 4%, and I wouldn't agree with that. I think that's not the best estimate. Jason's comment, yeah, we never know what the future is, but we are paid to make guesses. And I think we're paid to make reasonable guesses. And that's what we try to do over time. This is, again, an illustration of what you may have thought about in the past. The private sector, U.S. GDP, is actually doing quite well, thank you very much. The government sector is doing the restructuring. However, when you look at the graph carefully, you'll notice that the private sector is growing, but not at the pace it did in the prior 2 recoveries. And in fact, you can see there's almost a pattern there that private sector economic growth has slowed down by cycle. So again, I think that's pretty important going forward. This is your small business survey. Hasn't improved all that much. Just a few minutes ago, the Philadelphia Fed survey came out. That was disappointing. But this is your large manufacturing survey, and I congratulate Jason on that one graph, because I use a graph similar to that to emphasize how many of the S&P 500 companies in the United States are truly multinational. So you see 2 different stories. Small businesses in the United States basically struggling, trying to get ahead, moving forward slowly. Large businesses, most of the ISM survey, a very, very traditional business cycle. So you can have a sense that wow, you know, I got an economy that has very, very different actors and behaviors over time. I think that's pretty key. Jobless claims actually jumped this morning. That was a little bit disappointing, but jobless claims on average are probably one of your best cyclical indicators. And to me, it still says this economy is continuing to improve. I don't see a big recession out there. But I do see structural change. And this is the graph I mentioned earlier. This is the employment population ratio. It does, again, indicate to me that it's a different ballgame. First of all, it's really hard to get back to the imagined 3.5%, 4% trend GDP that some forecasters put out there. I'm glad they have a wonderful imagination. That's, you know, great to see, but I can't advise my clients on 4% GDP. The second thing is, as you know, if you flip this around, this is the dependency ratio. You get an awful lot of people in the United States depending upon fewer people working. That is a change in American society. And it doesn't mean we can't grow. It just says that some of the barriers and challenges are different than what we saw in prior decades. This is the labor force participation rate. I mentioned this morning. It's gone down for both men and women. So again, that is a long-term demographic challenge, I think, to a lot of people's thinking. I mean, if that labor force participation rate goes down, it is, again, staring you right in the face in terms of what exactly is our potential GDP. And then here's the unemployment rates. You know, once again, picking on David's presentation earlier, in terms of the U3 unemployment rate, that does mean revert. And surprisingly, it mean reverts to a number like 6.375% unemployment rates, which actually is not that far from the said 6.5. What is really different, though, is there is no mean reversion on the U6. That has broken out. It's a very different world, and I think a couple of people earlier this morning talked about part-time employment. It's a very different world out there in terms of part-time employment. Another thing that I thought was significant is that in the latest employment report that came out, you can get average hourly earnings by sector, and it was interesting that average hourly earnings in retail and leisure and hospitality actually declined. So we talk about average hourly weekly earnings, we talk about average hourly earnings, we talk about average work week, but it is interesting. The average work week has declined in those sectors that really focus on part-time employment. So there's something else going on there that we need to really pay attention to in terms of, you know, our policy going forward. Here's consumer spending. Again, sort of settled in. But here's the graph I referred to earlier. And again, very surprising to a lot of people. If you look at income growth after taxes, since 1984, it's the bottom 20% that has grown the most. And as many of you probably realize, that's a whole discussion of taking people off the tax rolls. More and more, we have taken the bottom 20% off the tax rolls. We've given them an earned income tax credit. That's all wonderful. It's all good. And it helps explain why discount stores, Family Dollar, Ross stores, TJ Maxx, all those companies can do so well if the unemployment rate is 7.5%. What happened here? You know, the unemployment rate's so high, I mean, these people should be, you know, falling off, disappearing from the consumer rolls. In fact, they're not. The highest 20%, no surprise. Home prices are going up, stock market's going up, the wealth effect has really improved with these people, and also, again, they have the skills to compete in the 21st century, so their income growth is pretty solid. The middle, the third 20%, the middle, that's JCPenney. So again, it's not surprising that JCPenney struggles. Their demographic has the least income growth over the last 30 years or so. So again, you know, you break down the American consumer, you get some interesting stories in terms of what's really going on. And again, remember, this is disposable income. Don't talk to me about pre-tax income. All right? I want to know what they got after tax. What do they got to spend? And again, another change in American society that is really important. As far as personal income goes, only 48% comes from working. That is a change in American society that's pretty interesting over the last 40 years or so. It used to be the story that, well, if you're not working, how are you going to eat? Now, again, it changes the consumer dynamic. So it's not surprising. Once again, consumer spending can be as good as it is when, you're focused on so many people getting income in other ways. Capital goods orders, this is definitely downshifted. And I would tie into something that Jason said. He, of course, had the more practical view. I'll give you the academic view. It's a Tobin Q. And I think that's why mergers and acquisitions are so good. you get paid a lot more to take over a company to invest in new capital. And I think Jason's got it right. Right now, you look at this and you can see that mergers and acquisitions are just moving ahead pretty quickly now, and investment spending and actually buying something has really slowed down. So I think Jason's got an interesting point there. Here's housing starts, and we do expect housing starts to continue to improve, but we do expect that the composition of housing starts has changed. A lot more multifamily. I think that is pretty good. In part because of what you see here. The average family size has continued to go downhill. Our grandparents in the United States may have had 4 or 5 kids. Our parents had 3 or 4. We have 2 or 3. Our children are talking about 1 or 2. And so what's happened is we've got much smaller families. And also, as far as the shadow inventory goes, I think it was a surprise to a lot of people. In the last business cycle, we built 5,000, 6,000, 7,000 square foot homes, 30, 40 miles outside the city. And people had long commutes. And then they figured out these houses really weren't worth what we thought they were. And that's true in Alabama. I mean, look at Georgia. It's fascinating. We have a system in the United States where we sort of compute metropolitan areas. And Atlanta's metropolitan area in the last 30 years has absolutely exploded, and it extends into Alabama. And what happened was all these people were building these huge homes in the suburbs of Atlanta, and now they got surprised because no one really wants them, and a lot of it's shadow inventory. I know because I can see the portfolio. And when you sit there and you say, no one really wants to be in Riverside, California, or Merced, or Modesto, or Stockton. They're too far from civilized, points of view. So again, it's key. And then this is the graph I referred to earlier. Once again, home prices are rising much faster than the mortgage rates. Again, you're setting yourself up, again, for a repeat of what we've seen before. Commercial real estate, look at the vacancy rate on apartments. So far, there's not a bust in multifamily. So for an investor looking at multifamily, there was a discussion maybe a year or 2 ago, too much multifamily is being built, who's going to buy all this stuff, who's going to rent it? So far, the absorption rate far exceeds constructions and completions. So the vacancy rate has come down pretty dramatically. Another thing that has helped in the United States is the industrial. The industrial vacancy rates have also come down. So there is a good basis for some, not all, of the CMBS issuance that's going on in the United States. Part of this industrial, as many of you know, has to do with the Panama Canal being wider and the development of ports and roads and docking facilities that's going on all the way from New Orleans up to Boston. So again, kind of interesting when you look at that. In terms of inflation's, again, it pretty much settled in here. This is a graph I mentioned earlier. You can look at that graph and you can see there's a drifting up. Is there a soaring, skyrocketing inflation expectation? No. Is it drifting up? Yes. And again, that's that subtlety you have to be very careful about when you're evaluating some of these fixed income products. We don't have skyrocketing inflation. We're not likely to have skyrocketing inflation. Jimmy Carter, forget it. We're not going to go there. But we do see that inflation expectations are modestly higher each year, 2010, 2011, 2012. You can see that thing moving up just a little bit. And you have to ask yourself time and time again, am I getting compensated for the inflation expectations over the next 5 years? Again, here's the graph I referred to earlier. That's why I don't like the University of Michigan survey on 10-year inflation expectations. It doesn't move. It would not have justified any change in monetary policy in 2001 based upon inflation. Okay, there was a recession, thank you very much. But you didn't have deflation in 2002, 2003, 2004. Inflation expectations were pretty steady. And surprisingly enough, when you look at 2008, 2009, there was no collapse. All right, in inflation. It's amazing how consumers in this survey can continue to have about 3% inflation expectations. So again, you look at this. And the other thing that seems irrational in the whole process, and again, I'll let Jason talk a little bit more about valuation, but how in the world do you expect inflation to average, 2.9% over the next 5 to 10 years, and the 5-year Treasury pays you 0.7%? There's a huge disconnect there. There's no valuation going on there, and that's why, again, I feel it's very, very tricky when you've got such dominant non-mark-to-market buyers in treasuries. I mean, you don't really have a legitimate market. You go back to all of our undergraduate education or maybe graduate education, and they said it's a willing buyer and a willing seller, and that's how we get a risk-free interest rate as a benchmark for pricing. Problem we have in financial markets is we don't have that. We don't have a clear benchmark risk-free interest rate to price all our assets off. What we do have is a 3-month, 1-year Treasury bill that, again, is dominated by non-mark-to-market buyers, and I think that's, again, very tricky business. Corporate yield spreads, really, I like the fact that spreads are higher still than they were in 2005, 2006. Tells me that a lot of people have brought a little risk into the process. But once again, this graph, again, it's why I'm overweighted equities. I'm getting paid to be in equities. I'm not really getting paid to be in a BAA corporate bond. So again, I'm not sure what Jason thinks about it, but I would overweight equities relative to bonds. And the other thing that seems strange is, look at this. I mean, investment-grade corporate issuance has really taken off. This is your Tobin Q in action. People are just issuing all kinds of high-yield debt and high-grade debt. Here's high yield. I mean, it's a totally different world. Yes, I worry about this, and I mentioned this at a lot of meetings. Once again, I sit in a meeting and I listen to all this stuff about covenant light all over again. And I'm thinking, wow, am I really hearing this conversation again? Am I really, well, we don't need covenants on this, and it's such an aggressive marketing process going on. So once again, I see that, whatever the perception is, it is just so much easier. Again, as Jason said, I can issue debt, pay some dividends, leverage up a little bit, and the cost of capital is incredibly low. And if I want to issue some debt to take over some company or buy some other company and do mergers and acquisitions, the money's there. So again, I think it's a change in behavior over time. Delinquency rates have come down, charge-off rates come down. And here's again, I think Jason had a graph similar to this. C&I loans are up. Banks are lending no matter what the character of the bank is. So C&I loans have improved pretty dramatically. Finally, corporate profits in the United States have become increasingly global. That's why Catherine can command such huge consultancy fees. But yeah, corporate profits, again, developing a portfolio as an investor, you have to look at corporate profits. And here's a list slightly different than Jason's. But this is U.S. companies listed in the S&P 500 with greater than 50% of sales abroad. And it's a who's who of America. So you can have an international portfolio from an American point of view without having to buy international stocks. And I think that's pretty interesting. I mean, some people say, well, I don't feel like, I don't feel comfortable with someone's accounting or the rule of law or anything else. Well, that's fine. Buy Coca-Cola. Buy Nike. I mean, these are really basic companies going forward. There was a comment. I love George's comment on interest expense. This is where the U.S. is, and that's, again, consistent with George's point that U.S. corporations are in a very good position relative to interest expense, relative to profits. Here's corporate profits as a percent of GDP. The long-run average is around 10.85%. What is interesting is that despite the rhetoric, when you do the mean reversion test, actually it does revert to 10.85%. There's no evidence so far. Yes, it may be an all-time high, but there's no evidence that today's all-time high is going to persist in the future. It may easily come down as the cycle changes. Remember, if you look at this, in the middle of a boom, it always appears to be at an all-time high. But I do believe that the character of U.S. manufacturing especially has changed. We have become far more efficient. We don't use as much capital. We use labor far less than we did in the past, much more capital. And also, I would emphasize to you that labor costs, and again, this discussion came up earlier, are not evenly important for all industries. If you're in textiles or electronics, labor costs are the most significant cost involved. If you're in chemicals or auto or steel, labor costs are not the most important factor. It's material costs. I would say, again, picking up on Jason's point, I would say two things. The price of natural gas being as low as it is for so long is a boom for chemical companies, but it also is a great break for a lot of residential homeowners because it means the cost of electricity through their utility or directly heating their house is lower. And that is a real help for consumers over time. So again, I think that's really kind of key. Another thing about domestic profits, look at that. It's non-financials that have really hit or surpassed all-time highs. And so again, you get a difference there in financial and non-financial. Federal budget balance, good luck. You saw my opinion on the FT article. Again, you got to get that thing down over time. And again, it's entitlements. There's no other way around it. And then, I mean, again, I'm sitting here and I'm thinking, CBO has a 4% GDP forecast in 2014. I don't get it. All right, you got fiscal. I mean, again, I'll do Mundell Fleming. All right, I got fiscal policy restraint. I got monetary policy ease. Yeah, I can understand interest rates are going to stay low, but I don't get a 4% GDP out of that. I think that's more of a result than anything else. So I think that's pretty much it. So we open it up to questions, comments.
Soon you'll think that I was paid to get the questions. Thank you so much. An observation and a question. The observation, I was struck by your chart, Jason, about the various companies that seem to have a very good, be a good candidate almost as a, how should I say, an alternative to sovereign. Back in the late 1990s, when we were hitting surpluses in the budget, there was a lot of talk that Ford would become the new U.S. Treasury, and then it's amazing how quickly that changed. But a question with regard to the corporates, and it's for both you and John, the corporate balance sheet. To what extent are you worried about the leveraging up, or how much of the leveraging up is refi at this moment, or is this the beginning of a new bubble?
Well, just to take that very quickly, I mean, I do think if you just look at from a balance sheet perspective, I'm not particularly worried about the amount of leverage on your average large cap company's balance sheet. I do think what is driving a lot of the corporate issuance is just simply is kind of the rainy day idea, which is to say this isn't going. People know this isn't going to last. After 2007, I think a lot of corporations saw the face of God and said, we don't go through that again. And they're doing something, I think, which is very smart, which is to say, as you pointed out, they're refinancing. They're doing something the U.S. government isn't doing. They're refinancing long. All right, so there's a lot of companies, not a lot of companies, but there have been more than a handful of companies that have actually issued 100-year debt. So, and which makes eminent sense, it seems to me, if you could, if you get away with it. So I think that's a good idea, but that's why I guess I'm still more worried about the Treasury than corporate America right now.
Again, Kathleen, I think you just have to be dynamic on this thing. Just to realize that the traditional pattern is that everything looks good right now, and then you've got companies, again, as Jason, I think, hinted at, who are not, don't have the biggest cash draw, don't have final sales that are really strong. And as this cycle matures in the next 2 or 3 years, and if we're back in Milan in 3 or 4 years, you will probably have 4 or 5 examples of companies that took up leverage and at the end of the day could not sustain final sales to pay off the bills. It happens every cycle. I'm sure it's going to happen this cycle, and that's the problem for our profession. The economy and the characteristics of financing changes over the cycle. It's not the same. Things evolve. And so, once again, I would say, yeah, you just have to stay on top of it and just say, okay, now who's leveraging up and what's realistic for final sales? I remember going through the whole high-yield bond era and just having people with unbelievably unrealistic expectations on final sales. I mean, you go through one of my jobs at Kemper was to go through the prospectuses, and you get like one paragraph of economics, and then someone's talking about retail sales growth at 8 to 10%. You're looking at the U.S. economy and saying, no way, pal, not going to happen. So that's our challenge in our profession, is to realize that the economy and the credit markets change over the cycle, and that what looks like a great deal today, you try to repeat it, 6 months or a year from now, it'll blow us up.
So this is a question for both of you. It has to do with your stock market, sort of expectations for the stock market. And so, Jason, you were looking at alternative models of PE and how you would, and based on that, what you expect the stock market to be going forward. And one of the things that we learned when we think about fiscal deficits is that it matters whether you adjust through taxes or through government spending. So the story is that you can't look at a difference, or looking at that difference shouldn't be your driver of your decision. And the analogy into the stock market is you're looking at earnings, and earnings as being the driver of what your expectations are for the market as a whole, or even for individual companies within a market. And what I'm asking is, what should we really be looking at in terms of the decomposition of earnings? Because you can have good earnings because you have good revenues and you've kept your costs under control, or you can have good earnings because your revenues are pretty bad but your cost reduction is fabulous. And you can have good earnings because you bought somebody who had good earnings, but in fact you're in really bad shape. And so when I understand why you're in the market now, because it's the only place to be, but what are the signals that are important going forward to identify the fact that there's no there for most of these companies, that in fact they've been generating high earnings off of activities that are going to generate no real earnings going forward?
Listen, it's a great point, and as John just showed, an interesting chart. He showed non-financial corporate profits at all-time highs, right? And corporate profits are at all-time highs. And the U.S., I believe, is doing that with, if I'm correct here, 5 million fewer workers than we had at the peak. So we had 138 million people in the workforce. Now we have 133 million, and you're generating more profits. Profit margins are at all-time highs. And again, last year, there were very evident signals that profits were not particularly strong. S&P 500 operating earnings, as I mentioned, were only up 40 basis points, and yet it didn't matter. I will say, over short periods of time, and I have this in this chart package, the correlation between profit growth and stock market performance in any one year is actually almost non-existent. It really tells you nothing about what happens in the current year. Of course, if you take a 3-year view, or a longer-term view, there's a very strong correlation between how the market does and the overall performance of stocks. So I don't know if I'm answering your question what to look at, because I think there are already evident signs that there's no there. And yet it leads you back to the same conclusion, which is a lot of it is driven by what the other alternatives are. We've been using this acronym TINA. There is no alternative, right? And that's equities in many ways are the TINA asset class. It's just as a result of financial repression, you just don't have that many other options. So I know it's unsatisfying, but.
No, I think, Catherine, you've identified something, and I think many of you can probably look at, or go to your financial advisor, or go through your own portfolio. And I think what Jason was hinting at in a way is that over the last quarter or so, we've seen a number of companies who make their earnings number not because of top-line revenue, but because of cost reduction. Okay, I got that. But, again, that would raise a question mark for me. And what particularly bothers me, Catherine, is that at this point in the cycle, I got to expect that my employment cost index or my unit labor cost numbers are going to stop rising. There's going to be a limit to how some of these companies can continue to perform on profits if their underlying costs start to rise. So I agree with you very much. I think it's, again, it's that story that, you know, for the person just reading the front page of the paper or listening to the evening news, wonderful. I'm glad, you know, companies made their earnings. But our job is to look below that and say, okay, how in the heck did they do that? And is that sustainable going forward? And again, you know, you have to be skeptical at this stage of the cycle and say, hey, you know, where are my labor costs going? What are my material costs going? What's going on here, company by company throughout your entire portfolio? And I was not happy to see a lot of these companies, they made their earnings because of the cost reductions they had and not what they did otherwise. I also liked one of the graphs, and again, one of the graphs you had I thought was really significant. I wanted to make sure everybody noted the change in corporate bond purchases by foreigners. That was one thing that really was lacking in the last 4 or 5 years. And in part, I think what you have is a lot of companies using the Tobin Q will say, I'll issue the debt to do what I need to do to buy this company, and I can market this debt abroad. And I think when you look at auto loans, the syndication of auto loans, again, you know, you talk about securitization, everybody hates it, but securitizing auto loans and selling them to foreign investors, big business. Syndicated loans have really, again, taken off. Once again, I would say, are we looking at the credit quality of these syndicated loans over the next 3 to 5 years? So that's our job as investment advisors, to sit there and say, hey guys, the market's changing underneath us, the dynamics is different, we need to take a closer look at some of this stuff. And so I think your question's quite appropriate. How did you make your earnings? And is that sustainable over time? And if it's really bottom line cost efficiency or whatever it is, all right, but I know the cycle, and the cycle tells me that unit labor costs, employment cost indices start to rise at this stage of the cycle. You got to be careful.
Just on that point, can you not argue, to take perhaps a little bit more sanguine outlook, that, well, we haven't really transcended to the next phase, which would be earnings driven by revenue growth, that we still are very much stuck in this cost reduction mode, if you will, that has been elongated because of you know, whatever we have here.
Right.
And that you have...
Go ahead. If Jason and I were sitting on an investment committee, okay, that I suspect would be his response. And I will say, yes, Jason, that's entirely true. It still looks like we're doing this, all right? But to me, what I bring to the table as an economist is, what the heck's happened with the economic cycle? What is the traditional pattern, okay? And Jason will say, you know, I know company A, B, and C, and they're doing okay. And I'll just say, okay, Jason, from an economist point of view, I would have at least one question mark. And he would say, oh, but the fundamentals look good, so I'm going to trump you with an ace of spades or something. And that's where the discussion is.
Yeah.
It's not, oh, this is the end of the cycle, everything's going to end. No. It's the point that you're in this cycle and say, okay, that's our job. My job is to say, what the heck's going on with the economy? And his job is to say, look at individual companies. This company still overweighs that.
But also, I mean, you know, you can say...
Yes.
The ace of spades is not your ace of spades, it's the Fed is the ace of spades. And when they decide not to play the game anymore,
Right.
you guys have a different game that you have.
You're not you're not kidding.
You'll be able to play that game
Yeah.
when it comes. It's a different game.
It's
like, remember back of credit analysis?
Oh, well, listen, I'm with you completely. I do think that what it argues probably, Kathleen, though, I would say is I would say a stronger case for active management of equity. I would say a stronger case for active management of equity portfolios, right?
Or any
Because
portfolio.
not every passive, you know, the irony I would say in the 80s, right, is that Of course, no one did this, but what you should have done is gone passive on all of your investments, right? Because multiples went from 6 in 1982 to 28 in 1999. But it was a great period for active management because people thought they could do even better. But of course you couldn't, but it didn't matter because you were still making money. What I would say now is if you're looking at interest rates, inflation, taxes, regulation might get a little better, but taxes have gotten worse. But inflation and interest rates, hard for them to get any better. It's hard to see a continuation of it's hard to see a continuation of multiple expansion well into the future. And that's one of the things that argues maybe what John is talking about. You have to find the specific companies that'll be able to deal with this. And
But you know, the other point though, and you know, at the risk of sounding heretic here, is the fact that in order to bring back pricing power for corporations, you need some inflation, hence the quantitative easing, and it's very cuspy. You get you know, you can, I don't know, let's say for the sake of the argument that it's 2.5% that you need in order to bring that pricing power. If it goes slightly above it, then of course revenues come down again. And this fine tuning, we're nowhere near there at this moment in time.
And again, the ace of spades, too, Catherine, need not be the Fed. And maybe Kozo wants to say something here. But what do you do with a central bank like the Bank of Japan that may at some point decide at the margin is no longer going to buy treasuries to stabilize their exchange rate? Could that set in motion a slight change, not a big change, but enough of a change in interest rates to make a difference? And I don't know if Kozo wants to comment on that. But again, at the margin, and we as economists are always at the margin, would that generate enough of an increase in treasury rates, that bid to cover ratio that you show? I mean, what a huge difference the bid to cover was between 0 and 5 years and then 10 years. And it was like, whoa, it's two different markets. So I don't know if Kozo wants to say something about that. But again, the ace of spades could be slightly different than what we traditionally expect. Kozo, that was a hint. You could Okay, and they could, absolutely.
Yeah.
They could come back and buy. So once again, at the end of the day, we really don't know what the risk-free return is in a marketplace. That's very tricky business when we're selling all this high-grade, high-yield bonds and everything else. I mean, what's our pricing standard? Oh, I guess we're going to go.
And it is the end of the day.